On YouTube, welcome back to another video, and in this video we're going to be going over the #1 model that you should be using right now to perfect your entries. If you're someone who's constantly looking to evolve as a trader, especially when it comes to your entries, whether that's being more patient, identifying which type of strategy that you should be trading, or you're just looking to better yourself as a trader and increasing your overall win rate, this video is for you. And throughout this entire video, I'm not only going to give you the step-by-step framework of what you need to be looking for to perfect your entries, but we're also going to be doing some backtesting, and I'm going to give you guys a trading plan towards the end of this video, so you guys not only learn from this video, but you have the steps necessary to implement and become a better trader. So first, we're going to be going over the reversal signatures. Then we're going to be talking about high probability zones and identifying those high probability zones. Then we're going to be going over higher time frame analysis and why that's so important. And then last but not least, we're going to be talking about the inducement model. This is something not a lot of people talk about, but you're looking at one of the best traders when it comes to ICT and SMC concepts. I'm going to break it down very simple for you guys, but also very extensive, so you guys to learn from the best. And obviously towards the end, we're going to be doing the backtesting, giving you guys a train plan and putting everything together. First, we'll talk about the reversal signature, and it's very important to understand how does a market move, and it moves in one or two ways. Either we're in a downtrend where we can clearly see that prices creating lower lows and lower highs within the markets continuing to go lower. Or we may be in a condition to where we're in an uptrend, where we can see prices creating higher highs and higher lows within the markets. But the specific point that we want to talk about is called the reversal signature. This is the point in which the market is going from one direction to another. In this case scenario, where we're going lower and lower, we identify this reversal signature, and now price is going higher. And the reversal signature is very simple. When we were in an uptrend, every previous high within the markets was referred to as a strong high, meaning that price was not supposed to break back above these prior highs, right? Creating lower lows, lower highs. The moment that we've identified this liquidity sweep where we took out this prior low, then we can see price break back above this prior high. This is our indication that, okay, we were in a condition where all these previous highs were protected and price was not taken out. But now, since price is starting to take out these previous highs, we could see a potential reversal taking place. So we got this liquidity sweep, and then we can see this breaker structure to the upside, right? It has to have strong displacement within it. We'll talk about that later on. You can see we had this breaker structure higher, and then this is very important. We can clearly see that price creates a higher low. When we're in a downtrend, price was supposed to take out this prior low, but the fact that it did not take out that prior low, instead it created this higher high and then this higher low. This is our indication that price is starting to go higher, right? During a downtrend, price should respect these previous highs and break back these previous lows. And during an uptrend, price is breaking back above previous highs and respecting those previous lows. So the moment that we break back above this previous high and respected this previous low is the moment that we can categorize this as a reversal signature. And this point right here is very, very important, because this gets us into our next phase. Within our reversal signature, after price has taken out a level of liquidity following the breaker structure in the opposing direction, just like so, that last down close candle that swept that level of liquidity would then be identified as our high probability order block. Order block is very, very simple. It's an area to where we can identify a potential strong point. When price swept this level of liquidity and then we saw this breaker structure to the upside, price came down into this level. This is a strong low. Price is not gonna break back below this low, because price is indicating that we're going from lower to now higher prices. So since this is a strong low, the last down close candle within that strong low point would be identified as our order block, right? Same thing for right here. If we had a last up close candle right here and this was a strong high, this last up close candle right here would be referred to as our bearish order block. A high probability order block is identified to what is the current trend, right? As the trend was going lower and price was respecting these previous highs, right? These last up close candles was our bearish order block. The moment we see a reversal and price is starting to respect these previous lows, those last down close candles then becomes our bullish order block. Price comes back within that order block level, sees it as a level of support to then go in the opposing direction. Just like I mentioned before, an order block is simply just identifying what is the current trend. When we're going from lower to now higher prices, the trend is shifting from lower to now higher, meaning previous highs inside the marketplace are not proper order blocks. Right, the real order blocks within the markets is now the bullish order blocks, because the trend is now shifting bullish. So if you want to identify whether to choose between a bearish or a bullish order block, just identify where are you within the trend. See, price comes out into that last down close candle that swept that level of liquidity, and then we saw this push to the upside. meaning that this low that tapped into that order block and then seeing this push higher, this low is now a strong low. When price comes down into this level, it should find support. The reason why it should find support is price should not break back below this previous low point. And then we see this push to the upside, price comes back down within that last time close candle, finds a level of support again until we reach back over higher prices, targeting back above these highs. After price has given us our reversal signature and we identified our order block zone, we want to look for what's called an inducement. An inducement is very simple, right? This is the area to where price creates that order block. We see this initial rally to the upside. Instead of just taking the trade as price taps into this order block, we want to look for what's called an inducement. It's when price comes close to tapping into that order block, but it doesn't really tap into the order block. Instead, it comes close to tapping into it, and then it gives a initial reaction higher. This initial reaction higher was not significant enough to break this previous high. So we want to see price come close to tapping into that order block and then give a slight reaction higher. And this previous low would be identified as our inducement. So don't just take the trade as price taps into the order block, or don't just take the trade as price comes close to it and then starts rallying higher. This initial rally higher was then that fake move. So once price comes back lower and taps into that order block, it not only taps into that order block level, but it also takes out this previous low. This previous low would be referred to as a liquidity pool. So any traders who were long, right, as price came close to the order block, most likely they put their stop losses back below this low. That's exactly what the market wants. They want to fake you out to think it's going to go higher, only then to come back and stop punch you and then create that real move. Who's been in this situation? You've taken a trade, you think it's going to go higher, and then price comes back lower to stop you out before then giving that real move. That's exactly how the market works. It's constant fake outs and iterations of how can we take out the most traders and fake out the most traders to use them as liquidity. So as price creates this initial rally higher near the order block level, price creates a liquidity pool at these lows. So once price comes back lower, it not only takes out that liquidity pool, but then it taps into the order block and then we see that rally higher. So make sure whenever you're taking an order block trade, you want to have it in alignment with an area of liquidity. And if you guys want a copy of today's PDF going over when to trade this model, what to look for, the time frames and everything like that, I will be putting it inside of the PDF section inside of the free Discord community. All you have to do is click the first link in the description and join the completely free Spark Trading Discord community. And if you guys want to trade live with me and my brother Spec Trades every single morning, as well as access to 100+ hours worth of additional lessons, courses, materials, and education found nowhere else, you guys can also click that first link in the description and join the Spark Trading Mentorship. As you can see, wins on top of wins between me and my brother Spec Trades every single day. We are live trading every single day throughout the entire year of 2025. So if you guys do want to live trade with us every single morning, as well as invest in your education to becoming a profitable trader, you guys can click that first link in the description, join the Spark Trading Mentorship. So we're looking at our first example here on the 1 hour time frames, and just before the market opens up, which we are coming into a New York session, 30 minutes prior to coming into our markets, we want to create what's called a daily bias. And a daily bias is very simple. It's basically identifying where has the market been, where is it currently at, and where do we anticipate the marketplace to go next. This basically gives us a framework of what to look for during the trading day. So if you can create this framework on the higher time frames before the market opens, when the market does open, you don't get faked out because you understand the higher time frame narrative. We're going to be looking at the 1 hour time frame when it comes to identifying the overall structure because it's the most consistent. The 1 hour is kind of in the middle between it's a higher time frame, but it's not too high like the daily, but it's not too low like the 15 minutes or the 5 minutes. And on the 1 hour time frame, some key things that we can take note of is obviously from the prior day, we can see that price came lower to sweep a level of liquidity at these lows. So you see price came lower to sweep that level of liquidity, and then following that liquidity sweep, we've seen this strong displacement to the upside. And as we can see here, it looks like we did have news around this level, which created a long wick within the markets. When you guys see long wicks like these within the markets, these are inefficiencies. And when it comes to these long wicks, what we can do is we can anchor a Fibonacci from the low of the wick to the high of the wick, then we can get our quadrants. So we have the 25% of this wick right here, and we have the 50% of this wick right here. And then last but not least, we have the 75% right here. And these wick levels would be what's called our draw on liquidity. You can see from this liquidity sweep in this breaker structure, we could see that price is obviously bullish. Even though we know that price is bullish, where do we anticipate price to go next? next. Since we left this massive wick inside the level, we know that this is an inefficiency. Price is obviously gonna want to come back into here. We have to understand how the market moves. It moves in expansions and corrections. When price creates an expansion to the upside, price is gonna create inefficiencies within that expansion. For price to continue going higher or potentially reverse, price has to come back within those inefficiencies to rebalance it. This is why you have scenarios where price creates higher highs and higher lows. It's simply just price creating an expansion, leaving inefficiencies to see an expansion higher, and so on and so forth. When price came higher to leave this long wick, this is an inefficiency. So if the market wants to potentially continue going lower or potentially going higher, it has to come back within this long wick level to rebalance it. We can mark this as a easy level of targeting. We not only identified that price is bullish, but we also identified that price has a level of targeting above us. Daily buys can be as simple as easy peasy 1, 2, 3. It does not take a rocket scientist to understand where has the market been in terms of structure and where we anticipate to go next. Identifying that daily buys, we want to get into our entries. And just like I mentioned, when it comes to validating the perfect order blocks, we have to pay attention to where has price swept a level of liquidity, as well as where has there been displacement. So we can clearly see that this liquidity sweep plus displacement move to the upside. This most likely indicates that smart money is in the markets. As a retail trader myself, as well as you guys, we do not control the markets, right? We don't have the power to move the markets hundreds of thousands of pips. We just don't have that capability. But banks, institutions, as well as smart money, they do have that power to do so. If we can identify an area to where there was strong displacement of volume, that last down close or last up close level would be identified as our order block. Can identify from this low level to this high, we've seen price move over 105 pips, right? That's a drastic move to the upside, meaning that smart money is most likely in the markets within this specific area, as well as we did take out this previous low. These last down close candles right here, which took out this prior low, this would be identified as our bullish order block. I swept a level of liquidity, and then we had a strong displacement of volume in the opposing direction. These are the two characteristics that we want to look for inside the markets when it comes to validating our highest probability zones. The chances of price failing within this zone is lower probability, as well as we can identify that we have a draw on liquidity above us, which is reaching back above higher prices. And this gets us into our next step, which is identifying that inducement. As we can see here, we have these levels of liquidity, which we can see price came close to that last down close candle once, and then it came close, very, very close the second time, but it did not tap into it. This is exactly what we want to look for. This is where price comes close to that last down close candle, but it doesn't necessarily tap into it. It gives a fake move, meaning this order block level is what we call unmitigated. This is a level inside the marketplace which hasn't yet been tapped into. If we want to take the highest probability trades inside of an order block level, it has to be unmitigated. As well as above it, we can identify this liquidity pool. So this would be identified as our inducement setup. So not only do we have an unmitigated order block, which is a level that hasn't been tapped into, we have a level of liquidity above us, meaning this is an A+ setup. Now, the last thing that we want to do is we want to wait for time. The New York session is just about to open up. I'm going to go down to a 15 minutes time frame, and I'm going to want to see price come down into this level, frame my entry to reach back above higher prices. Down on the 15 minutes time frame here, the New York session is just about to open up. I want to see if we can see a drop to the downside, taking out this level of liquidity to then reaching back above higher prices. And just like that, we're basically finished, right? Notice how 30 minutes before the market opened up, I created a daily bias. That daily bias showed me what I needed to look for that day. Meaning if price opened up and see the drop and just continue going lower, I didn't have a trade. Right? When you create a daily bias, you create a game plan for what you're looking for. Same thing with sports. You're a soccer coach, you create a game plan for your players. Your players know exactly what to expect when they get out on the field. You create a daily bias so you exactly know what to expect when you come onto the charts during your respective time. And creating that daily bias puts us in a position to where we do not get faked out. We know exactly what we're looking for, the exact setup that we know that's going to play out, and all we have to do now is be patient. And as we can see right here, price comes down into that order block level, and then we see multiple rejections from this level, right? So obviously once price taps into this level, you want to frame your entry. You want to make sure you have a stop loss back below the low of that order block level, because we understand that when price came lower to take out this level of liquidity, and then we see this break to the upside, this is a strong low point, right? There's no reason for price to break back below this lower level. Right, the overall order flow or trend of the market is higher prices. So if we have a stop loss below this level, we're safe. Stop loss placements is very important inside of trading that not a lot of people talk about. Right, where you put your stop loss is way more important than where you put your take profit. So make sure when you're trading, you put your stop loss above or below strong highs or strong lows. After we've identified our entry, our overall stop loss placements, can now target back above higher prices. I'm only going to target back above here into that 25% of that long wick for about a 3 to 1 hour, just being very conservative. Basically, at this point, I put my trade back at break even. This would be a risk-free trade. Just keeping things very simple, we create that daily bias of what we were looking for. We can see that liquidity sweep break the structure, price was overall bullish. We had an area of targeting, which we had the 25, 50%, 75% of this long wick. Then we were looking for our high probability zones. We identified this high probability order block. It had a level of liquidity above it, so that was our inducement setup. Waited for price to induce that previous low plus tap into that order block, and then we got our trade idea reaching back above higher prices. Keeping things simple, easy peasy, 1, 2, 3. If you guys want to see me trade this model live every single morning, as well as access to 100+ hours worth of trade breakdowns going over this exact model, access to all the education, courses, ebooks, everything like that, you guys can click that first in the description and join the Spark Trading Mentorship. As well as if you guys do want one-on-one personalized help, where me and my brother Spec Trades will personally hold your hand until you're profitable, you guys can click the second link in the description and join the Spark Trading University. That's gonna be it for the video. I hope you guys got a lot of value from this video. Make sure you guys click that like button, subscribe if you're new to my channel, comment what you guys want to see next. I'm your mentor, Arkhamtrades. Be safe.